Continuing topic 4 of paper 12, we're now going to look at performance, measurement, and evaluation. Now, they're guaranteed to be questions from this section in any paper 12 exam, and I'll highlight where they'll be coming from or tend to come from as we go through the material. So we start by asking the question, what is performance measurement? First bullet point, worthy of note, the measurement of returns over a given time period for a given level of risk. That's what they define as performance measurement. Now, why do we measure performance? Indicates a fund's success in achieving investment strategy, monitors outcome of investment management decisions, etc. Have a look through the reasons. It's very straightforward. Now, qualitative analysis versus quantitative analysis. Now, this is the analysis of the performance of a fund. Now, when we're looking at qualitative analysis, we're looking at the people and the organization that's backing the investment manager, who the investment manager works for. There are advisor groups that outsource qualitative analysis to external research house or asset consultant. Now, qualitative analysis criteria, what are we looking at? Ownership, capital structure of the organization, staff and organizational strength, investment philosophy and style, asset allocation process, risk control, compliance, custody of assets, reporting charges and support services. So it's how does the investment management company operate? How is it staffed? All the qualitative features. And hopefully, if they're strong, that will be reflected in the quantitative analysis, which is what we look at the bottom of page 4.18. Techniques usually focus on past performance, on actual performance holdings, or portfolio holdings, I should say. Now, the qualitative findings are expected to be reflected in quantitative results. So if you were looking at a very strong organization, then it would be disappointing to see that their performance is poor compared to others. Now, researchers, when looking at past performance, are going to look at annual performance relative to market cycles conditions, and annual performance over 5 to 10 years to see if it reflects the investment style. Also, comparison of performance with benchmarks and peers. Now, comparison with benchmarks and comparison with peers, very important. Could be questions on that, and we go into that in a lot more detail in a moment. We also have attribution analysis that can be examined, and we deal with that at the end of this topic. Now, for an equity portfolio, you should be reviewing, when we're looking at quantitative analysis, the stock fundamentals. You'll be looking at the dividend yields that are being achieved and the PE ratios. You'll also consider tracking error, and we'll look at that at the end of the topic. But tracking error is looking at the volatility of the alphas, volatility of outperformance, more of that to come. And also we'll consider sector tilts and spreads towards large versus small cap stocks. Now, the two comparisons, peer groups and benchmarks, index benchmarks. Now, with the peer group comparisons, managers measure the performance relative to that of their competitors. How are they doing? Are they outperforming the competitors or underperforming? Tables are produced ranking investment managers. Now, what can be examined is the disadvantages of using peer group comparisons. What are those disadvantages? Investment objective may differ among managers, so they're not directly comparable. May not be enough competitors to compare with when a new fund is introduced, so such comparisons really are meaningless. New funds cannot be included due to lack of performance history. Surveys are only in a monthly or quarterly. They're not bang up to date, and performance is historical, may not be maintained in the future. That's the normal caveat. Okay, so disadvantages of peer group comparisons, tuck those in the back of your mind. Now, index benchmarks commonly used to monitor performance. How are we doing compared to the S&P, compared to the Hang Seng Index? Now, the index selected for such comparisons must be representative of the fund's investment objective, with particular regard to type and weight of the securities the fund is permitted to hold. So how close is the index to the underlying fund that's being managed? Now, the index must be widely available to make sense. Active fund managers can use indices to judge their performance by taking neutral asset allocation on the performance benchmark and compare their performance, calculate neutral asset allocation according to the relevant market index, and they can compare the actual return to the benchmark. Now, what are the disadvantages of using an index to judge performance? Be aware of these as well. Disadvantages are very easy to examine. The assumption that the fund's risk is the same as the indexes can be a disadvantage. It may not be a correct assumption. Index may not be representative of the fund's investment objectives. There may not be an index for a new type of fund, just doesn't exist. Time period for comparison should be meaningful. That is a number of years. Managers may be tempted to exactly mirror the index. Temptation. Historical data cannot indicate future performance. So those are disadvantages. As I say, easy to examine if you're setting multiple choice questions. Okay, let's move on to the numbers. And yes, these will be examined. May not be all of them, but certainly one, maybe two. Now, these are risk-adjusted performance measures, and the performance can be more precisely measured using these measures. They consider both return and risk of a portfolio, and the three that we headline: the Sharpe ratio, the Trainer index, and Jensen's alpha. Sharpe ratio, capital market line; Trainer index, security market line; Jensen's alpha, also security market line, and the capital asset pricing model. Okay, generally, you're looking for portfolios that give you the highest ratio or index. Let's start with the Sharpe ratio. It's derived directly from the capital market line, showing the relationship between portfolio risk, that's total portfolio risk, and portfolio return. Now, a portfolio that lies on the capital market line will have an expected return equal to the risk-free rate plus the risk of the portfolio multiplied by the slope. I wouldn't worry about that point. We'll look at the types of calculations you have to do in a moment. Sharpe ratio measures the excess returns of a portfolio, that's excess over the risk-free rate, divided by the portfolio standard deviation, total standard deviation, not just systematic risk, reflects total risk. And there's the formula: RP, return of the portfolio, minus the risk-free rate, divided by the standard deviation of the portfolio. You need to know that to do the calculations. Now, a portfolio of the Sharpe ratio greater than the Sharpe ratio of the market portfolio is said to have beaten the market and will lie above the capital market line. So for the Sharpe ratio of the market portfolio will lie on the capital market line. And as you can see in that graph, if the Sharpe ratio is greater than the market portfolio Sharpe ratio, you're above. And if it's less than the Sharpe ratio of the market portfolio, you're below the capital market line. Now, this will become clear when we do the following examples. So, Sharpe ratio example. From the following information, we're asked to calculate Sharpe ratio for each portfolio, identify any portfolio that outperformed the market portfolio, in other words, above the capital market line. Now, these are the types of data that appear in the exam. And if it comes up, it can be time consuming. You've got theoretically 1.5 minutes per question. I wouldn't do these questions immediately. I'd get to the end of the exam and then give myself as much time as I can to work through these questions methodically. Okay, so the Sharpe ratio calculations. First one, the market portfolio. Now remember, return of the portfolio, 0.1977, minus the risk-free rate, 0.07, divided by the standard deviation. Now, the standard deviation of the market portfolio is given to us, 0.31. So that gives a Sharpe ratio for the market portfolio of 0.412. Then we do the same calculations for each fund manager. You take the return of the portfolio, 0.14, moving down, 0.16, moving down, 0.18. In each case, you deduct the risk-free rate of 0.07, and you divide by the relevant standard deviation. You can see A is 0.17, B 0.17, C 0.28. Then we look at the numbers that we produced. Fund manager A, 0.412, exactly the same as market portfolio. So fund manager A is on the capital market line. And therefore, fund manager A has achieved the return of the market portfolio. Portfolio B has got a greater Sharpe ratio and so is more attractive. It's for a given level of risk, it's made a higher excess return than the market portfolio. But fund manager C has made a Sharpe ratio lower than the market portfolio. So fund manager B lies above the capital market line, fund manager C lies below. So portfolio B has outperformed the market portfolio. Portfolio C has underperformed the market portfolio. Right, that's worth a question in the exam. 1, the calculations, and 2, the interpretation. So be very comfortable with that and do as many practice questions on that as you can, ideally with Examinator.online. The trainer index derived directly from the security market line, showing the relationship between expected return of investment and systematic risk. And in this case, systematic risk is measured by beta. So we're not going to look at the standard deviation, the total risk. We're going to look at systematic risk as measured by beta. Now, the trainer index of the market portfolio is the market risk premium, because we would be dividing by 1 beta of the market. Portfolio with the trainer index greater than the market will lie above the security market line, and a portfolio with the trainer index less than the market will lie below the security market line. So you can see it's the same pattern as the Sharpe ratio. Portfolio with the highest trainer index will be preferred, as it will provide the best risk-adjusted performance, that is the portfolio return beyond the risk-free rate. Now, the portfolio with the highest trainer index will be preferred, as it will provide the best risk-adjusted performance. Same decision rule as the Sharpe index, and the trainer index measure the excess returns of a portfolio divided by the portfolio systematic risk, and there it is. Return of the portfolio minus the risk-free rate divided this time by beta. Let's look at an example, the trainer index, and you'll see that the data is the same as before. So let's move on and calculate for each fund manager the trainer index. So the market portfolio return minus the risk-free rate divided by, well, this time it's the beta of the market, which is 1. So we get 0.1277. Then we calculate the trainer index for A, B, and C, and you will see that A comes out at 0.0636, less than the market portfolio. Fund manager B, trainer index 0.1, less than the market portfolio. But fund manager C this time has a trainer index above the market portfolio. So interpreting these calculations, you see that portfolio A has underperformed the market portfolio, lies below the security market line, as does portfolio B, underperforms the market portfolio, lying below the security market line, whereas portfolio C has outperformed the market portfolio and lies above the security market line. Now, are you going to get a Sharpe and a trainer calculation? You could. But you're certainly going to get at least 1. And I would be very comfortable doing those calculations before going into the exam.